Okay, so really excited about the financing webinar this evening. As many of you know, interest rates have been a standout headline in the news recently, and it's really great that we're going to be able to cover recent updates and how to best navigate purchasing real estate in 2022. So in a few minutes, I'm going to be introducing our preferred lender, Reed Hazard from CMG Financial. Reed and his team have been a critical part of the growth of Marshall Reddick and have helped thousands of our clients obtain financing for purchases, as well as leverage their equity through refinances to expand their portfolios. So he's a wealth of knowledge and super excited to bring him on. But before we have Reed give his 2022 outlook on lending, I wanted to quickly cover who Marshall Reddick is and what we do, for those of you that may be a little bit newer to to us. So Marshall Reddick is a full-service real estate firm, and we focus on four primary services, that being real estate brokerage, property management, private lending, and then our investment fund. So for real estate brokerage, we help people buy and sell property, whether that's a primary or an investment property, or whether that's in California or whether that's in one of our out-of-state markets. For our property management, 99% of the folks that end up buying an investment property are going to need property management. So we help them with everything from A to Z, right? So that includes marketing the property, showings, screening tenants, rent distributions, any kind of maintenance issues, the tax information that's required at the end of the year, for 1099. So we would handle everything that would be responsible for the owner on their behalf. So that's a huge part, in my opinion, of the success in growing a real estate portfolio. Our third service is private money lending. So we actually have two clients there. We have our borrowers and then we have our lenders. So an example of borrowers would be folks that are looking to do a fix and flip on a property. That would be a good borrower. Another good borrower is the folks that have self-directed retirement accounts that are looking to leverage and buy a piece of property using a non-recourse loan. Private lending solves that issue. On the flip side to that, we have our lenders. So the same way that you can invest in properties, you can also invest in mortgages. So we help those individuals, instead of collecting a rent check, you would collect a mortgage payment. And then our final service is something new. Within about 2 years, we launched our Marshall Reddick Mortgage Fund. So it's kind of a pivot from it's kind of in the same vein as private lending, whereas instead of investing in an individual mortgage, you have the ability to invest in a fund. So our fund has multiple mortgages, hundreds of mortgages, where you can have a contribution, as low as $25,000. And then you can be part of a larger, almost like a syndication, right? You're part of a larger fund that is, providing financing to the borrowers that I mentioned earlier. So, those are our primary services. That's what we focus on. And my goal is to make the process of investing as seamless as possible by educating and introducing our key players that work with us to make the whole process happen. So my name is Vince Tomich, and I'm an advisor here at Marshall Reddick. And as I just mentioned, my primary role as an advisor is to learn as much as I can about each investor and to help guide you through the process to achieve your investment goals. A little bit more about myself. I was born and raised here in Southern California, and I've been in the real estate industry now for over 7 years. I'm an investment property owner myself, and I definitely believe in practicing what you preach. I think I'm really fortunate to be in a position where I like to practice and do some, the things that I'm advising on. So it's really easy when we're just talking about real life things like that. So prior to my role as an advisor, I was a mortgage lender for a number of years, and that's where I really learned the value of leveraging money and how important financing is to grow a real estate portfolio, which is why it's so awesome that we're able to get Reed and his team on to educate us on kind of current trends and what's going on, because the financing role is so pivotal in growing that. So a little bit more about our market. So we're in 16 markets across the country, but you can see that there are a handful of highlighted cities in green. These are markets that we have a physical footprint in. So this means that we have offices, agents, property management, etc. So yes, this is these are markets where we have like I said, a strong footprint, and we can definitely provide full service type of experience. The cities that are not boxed in green, we still have great resources, except that is not a Marshall Reddick office where we actually have employees that work for the company. We do rely on some referrals, which are great, but it is just a little bit different of a process when it comes more to the property management side. So if anybody has questions about that, I can kind of take that on a separate call. But yeah, that's a little bit more about where we focus. Now, as we discuss financing and potential purchases of investment properties, some of you might ask, like, how do we choose where to invest? How did we come up with these markets? So, we've taken the time to vet out specific markets that we want to focus on. I think we can all agree that not every market across the US is a good market to invest in. So we've put together some key criteria we feel support strong investment markets, which includes, strong job market. We want to have areas that typically have low vacancy rate. We want economic diversity, housing affordability, right? So like, here in Southern California, it's quite expensive. So getting into markets that are maybe more affordable makes sense for those investors. Landlord friendly is key. Strong education, right? Good schools and whatnot nearby. And then last but definitely not least, reliable property management. It's so critical to have that service in line and to be able to rely on that for future growth. So that's a little bit more about the high level of what we do. Again, I'll be, as soon as after I bring up Reed, I'll be wrapping up the call, and we'll be going over, we'll be doing follow-ups to that. If there are any questions, we can totally take that. So, but without further ado, I'd like to introduce you to Reed Hazard with CMG. As I mentioned earlier, Reed is a pivotal part of the success of Marshall Reddick clients, and I've worked with him on countless transactions, and I highly recommend him for all future clients that are on this webinar. So Reed, I'll let you go ahead and take it away.
Awesome. Thank you, Vince, and super excited to be here tonight with everybody. I think interest rates are always an interesting topic, and lately, though, have definitely been more top of mind because they've obviously been going up a lot. We've had some trend changes. So I'm excited to discuss some of that tonight with you guys and dig into the details. So yeah, thank you, Vince and Marshall Reddick, for having me. A little bit about myself. I've been doing this now for going on 18 years. I started with Marshall Reddick as an intern in 2004 and quickly got acclimated into the industry, got a real estate license that same year, and started working with one of the lenders at the time. At the time, there was 5 different lenders, and I became the director of marketing for one of those 5 lenders, American Direct Mortgage. They were out of Topeka, Kansas. And so I went to the 18 different club meetings and taught on financing programs at the time that were available. And again, that's really how I got started within Marshall Reddick. Just found a true passion for it, started doing my own loans. And through the downturn of 08, 09, 10, 11, 12, never left the industry, grew a lot during that time. Didn't have a family yet, so that definitely helped. But yeah, I've never left the industry. This is what I've done for my whole time, really working in a professional career. So I love what I do. I'm nationally ranked in the top 100 loan officers nationwide for loan volume. A lot of that is attributed to Marshall Reddick and to the growth that we've seen through Marshall Reddick over the years. Again, this is really my flagship. But yeah, and then me and my team, me and my partner Al Rodriguez have the Rodriguez Hazard team, and we have been the top producing loan volume team in all of Orange County since 2018. So a lot of the agents know us in this area, and we love what we do here locally. And then I purchased my first property when I was 19. I currently own rental property in Orange County, Austin, Texas, and San Antonio. I don't see the need to go outside of those areas. They have everything that I'm looking for. Again, there's some great markets outside of these within Marshall Reddick. I love Florida. Really, really like Tennessee. So I can see myself doing property there in the future. But as of right now, I just love the properties that I have, and Marshall Reddick manages those for me and really helps us to be a couch potato investment. What that means is, that you only have to look at your investment as often as you're turning the channel. I don't spend a lot of time on my investments. I want them to be passive. I want to focus on my job and what I do for work. And I want these investments to be as passive as possible. So I feel that when you do this within the markets that they manage in, Marcia Reddick manages in, I feel that has allowed me to truly be able to take my foot completely off the gas, if you will, or just really not having to put any time or very, very little time on my investments. And then I've worked with over 1,000 Marcia Reddick clients. I've probably worked with at this point going on 10,000. But yeah, just love what I do, and I already work with a lot of the Marcia Reddick clients, clients that have just started with an MR, and then obviously clients that have been here for as long as 20 plus years. Marcia Reddick's been along a very, very long time. And I'm always excited when I talk to a client that's from 2003 or 2004 or 5 and I haven't talked to yet, and it's always blows my mind to see how they have multiple properties already with Marcia Reddick and how what they learned back then got them to where they're at today. I can feel that personally, and I see that in my own life. So it's just super, super cool to see what real estate does for you over a decade period or over a 15-year period. You really, really start to see it change your life for the positive if you buy with the right down payments and if you buy with the right teams and if you use property management. And last thing that I had on this list that I thought was super important is that we're licensed to lend in all 50 states, which is great. So same company, which makes things a lot easier as you build your portfolio. What we're going to be covering today, getting pre-approved, just what does that consist of? How does it give you an edge on the market? How does it even help you negotiate in this market? Best programs that are available for buying an investment property or a primary residence. I'm going to be covering different loan programs, conventional loans, FHA, VA, which are both government loan programs, jumbo loan programs, and I'm going to cover the all-in-one loan a little bit as well. With rates having gone up, I feel like that product in particular is really fascinating. It's had me looking at it more lately, and I'm starting to do a lot more of them, and I do believe that they really make a lot of sense for certain clients. So I'll be covering that product as well. That's actually a proprietary product of CMG. CMG Home Loans is my company. And so that product was actually created by Chris George, who is our president and CEO, and it's a phenomenal product. I'm going to be covering some of the private financing options when you can't qualify for my type of financing or conventional full documentation financing. When you can't qualify for those types of loans, I'm going to be covering the next best thing, and also different ways that you can buy with private financing out of your self-directed retirement account. Lastly, I'm going to be going over just a market update. What's happening with rates? What can we expect? I'm going to be talking a little bit how this current market resembles a market we had a couple of years back. Not entirely resembles it, but how there's a lot of similarities. And I'm going to give you guys some ideas on what I think could be coming together. Okay, so if we're getting pre-approved, we do a fully underwritten approval, which means that your loan goes to the person that's going to be making the decision later at the very beginning of the process. So when you fill out your loan application with us, we're going to send you a document request. You'll upload those documents, and then your loan will go to the underwriter. The underwriter will review the loan, run the loan through the automated underwriting system we have, put a loan number on it, and literally process a loan approval. So why we do this, it's expensive to do this because, frankly, you have to pay people to do this before you've even closed the deal. So we don't get paid until the deal closes. We don't charge an application fee. We don't charge anything like that. So to do this at the very beginning of the process, it is costly. Why I do it, though, is because over the years, we've built an amazing team and we've got a lot of business coming in the door. And I feel allocating the resources to doing a fully underwritten approval, even before there's 100% commitment that we're going to be closing a deal, that this is the way to do it. This puts you in the front seat, and there's so many benefits to it. So this is the system that I go through. Again, if you end up not buying, if 6 months goes by, you don't find the right property, you can come back in a year or 6 months or whenever and say, hey, Reed, I want to buy again. We'll update some pay stubs and bank statements and get you reapproved. But there's no commitment to have to go through this process. And so we provide this for all of our clients. It's going to allow you to be fully underwritten. For example, in the state of California, the purchase contract recently was changed. And there's 3 different options on there that says you've been pre-qualified, you've been pre-approved, or you've been fully underwritten approved. And so you'll be able to check that box, for example, that you've been fully underwritten. So things like that do matter. Getting approved really, really, really matters. And getting approved to the right lender. Now, you don't have to do this for every borrower to have success. I have some clients, they have no other properties. They own their primary residence. They've got $500,000 in cash sitting in a checking account. And for a loan like that, I could look at it, run the credit, get their income documents, put it together, and as a loan officer say, this is a good file, and I could pre-qualify it. The point is, again, this is just getting you way more organized. Even if you are that client, get us the documents ahead of time. Get prepared. Send us over everything so that you can keep going to work, living your life, being focused on that. And when we get the offer accepted, you're not having to stop what you're doing and get all those things. So there's an organization basis in this also. Even if you are that perfect client, if you're a more complicated client, like you're self-employed or you have multiple rental properties, just another reason why you really want to get approved to the right lender. But again, even if your file is super easy, it still goes through this process. It puts us in the front seat. And I'm going to kind of cover on my next or 2 slides from now why it's so important. Now, when you get pre-approved for this process, we do a loan application. You do it through my website at reedhazard.com. I'll send you all these instructions. Really, we start with a consult call, and I spend 30 minutes getting to know you, going over what you're looking to do. Then I send you the next steps over email. We get the application, we get the documents. We do run credit because we want to do what's called an automated underwriting system approval. So we want to put it through the loan system and actually get an approval. And how you do that, you got to have credit. So we get that part done. It will not hurt your scores if you don't constantly take out new debt, and if you're not late on different things, and if you're always paying, payments on time, it shouldn't affect your score one bit. Even if you think you have perfect credit, we've ran credit for people before, and there's something on there you didn't expect. This is another reason why just let a lender run your credit. Let us run your credit. Let us get you approved the right way. There's things on there sometimes that you don't know about, that your credit monitoring system does not catch. Sometimes a collection from somebody from some $40 medical bill that you didn't know about. I've had things pop up for people. So for that reason, we want to know about that ahead of time. We get all the documents. So the documents for your income, the documents for your assets, where the funds are going to come from. We then submit it into underwriting. This is all done within, about a day, and we get it underwritten approved. Then we follow up with a copy of the approval letter, and we base it on what the max is that you qualify for to start. Now, the reason why it's so important, first of all, is to understand your true buying power. If you're a first-time home buyer, obviously you want to know the max that you qualify for. Then you want to know what are the payments I'm comfortable with. So we'll qualify you based on the max, and then we'll go, okay, what does that look like? Okay, what is the payment with $4,500 a month look like? Okay, this is what it'll look like. Here's a breakdown of that. We also go over the closing costs you can expect. How often are property taxes due? Just things they don't teach you in school. So when you're a first-time buyer especially, we will go over all those things. We'll go over the payments. And to really understand your buying power is the most important reason why you get approved, in my opinion, especially because you're going to be married to this loan. So even more than what the sellers think and everyone else thinks, you got to get approved so you know what you qualify for and you know the numbers before you start going out there and placing offers on properties. Another reason is you can write a much better offer. So sellers will not consider you a legitimate buyer if you've not become approved. If you're pre-qualified and you have a big proof of funds that the agent sends, you could still get an offer accepted. I'm not saying that no one's never gotten an offer accepted with just a pre-qual letter, but it's a lot harder, and it's a lot harder to negotiate. Another thing is, in this market, when you get approved ahead of time and you get into escrow, you have a lot better opportunity to negotiate in the escrow process. And what that means is, one of the first things you're going to do is you're going to get a home inspection. And your realtor at Marshall Reddick is going to review that home inspection. And then they're going to go over that with you. And they're going to go, hey, it looks like there's about $4,000 worth of stuff. Well, at that point of the process, if you can come back to me and go, hey, usually the Marshall Reddick agent will go, hey, Reed, how does the loan look? Well, we're only 7 days in. We're already underwritten approved. Appraisal just came in. We're already ready to get our closing disclosure out. Awesome. That's great to know. So are you telling me you can get us clear to close in a couple days? Yes, I can. Awesome. Let's get the loan cleared to close. Then I'm going to go back to the sellers and I'm going to negotiate to give a $4,000 credit. And when I do that, I'm going to tell them that I can release the loan contingency a week early. We're already fully approved. We can release the contingency right now on the loan. We can even close a week earlier if you want. But like, my buyer needs to get this approved. We need this. And in a lot of situations, because you can release, because the loan is that much further ahead, because you got approved ahead of time, you got the lender all this stuff way before you went out shopping. You made sure you got them every last thing they asked for, so you're underwritten approved. Like, that's going to give you a lot more ability to negotiate throughout the process. And people just don't think of that. So that's another reason why it's super important. And then just organizing your plan. So we have a lot of clients in Marshall Reddick that are selling property and doing 1031 tax-deferred exchanges and are exchanging that equity into different markets. Some clients, maybe they bought property in 2007 in Alabama or in, no offense to Alabama, but, the economic activity there versus somewhere like Texas. I'm sorry, I'd rather have my money in Texas. Maybe you had properties in areas that you want to get out of. The values are up now. You can exchange out of those markets and into one of the Marshall Reddick markets, or into Florida, or into Texas, or Indiana, or Tennessee. And so you need to buy multiple properties at once. Quick story, I have a guy, he sold a home up in Burlingame not too long ago. He had about $2.8 million he had to exchange. I think he had about 1.7 in loan he had to exchange. We ended up buying 9 properties. We bought 4 in Texas, 3 in Florida, 1 in Tennessee, and 1 in California. We did all of these at the exact same time, So how did he have peace of mind knowing it was all going to get qualified? We got him pre-approved ahead of time. We went over all the numbers ahead of time. And we got them organized where, like, we were able to manage and do that many files at once. So if you're looking to do an exchange, especially, like, let's get approved, let's go through all the details, let's find out how much that you can buy with. Maybe you want to exchange up. Maybe you want to buy more real estate now with this exchange you can do. You don't want to just replace the equity value and the loan value. You want to get twice the amount of equity value and twice the amount of loan value and really exchange up. Maybe you're 45 years old and you're in this 20 more years. This is the biggest exchange of your life, So talk to your lender, get that planned, and we get you fully approved for something like that so that you can really maneuver quickly. So another very, very important point, though, because we're doing so many exchanges right now. So just getting approved with the right lender. Most lenders, they run your application, run your credit, send you a letter. You think that they're doing you like a service, or they act like they are, but they're not. They're not doing you a service at all. They're actually going to create a headache for you after you get into the loan process. Couple of commonly asked questions. How long is it good for? Our approval is good for 120 days, and then we'll come back and start updating stuff at that point. Also, if you go more than 30 days, you're going to want to update your bank statements either way, because that way when the realtor places the offer, they can provide proof of funds, proof that you have the money to buy with, and those statements are updated. We don't want to ever submit statements that are from March when we're submitting an offer in May. We update your pre-approval letter too, case by case. Realtor will come to us, go, hey, we found the property, they love it, here's the address, here's the offer price. Well, me and my team update that with the address, offer price, current date, and we send over the approval letter for the offer. You want updated bank statements for that offer. You want to look nice and organized, okay? Now, what if you're not looking to buy for 4 to 6 months and you don't want to have your credit ran? That's what a consultation's for. Let's get to know each other. Let's talk through that. Let me give you advice. Like, I'm not in a hurry at all. It's actually the opposite. I want you, when you're ready to go through that part of the process, that we're getting everything quick and that we're committed to getting that done right. So I love consultations. We can build a game plan together. Maybe you're looking to sell some properties next year in 1031 and you want to have a good idea of what this is going to look like. Like, I'm so excited about building a relationship. So that's how we can do. We don't have to run credit if this is going to be pretty far out. If it's in the next 4 months though, and it's for sure going to be a for sure thing, like you're going to be selling to buy or something like that too, let's do it now. How long will it take to process the approval? It's about 24 to 48 hours. If you have multiple corporations, 7 investment properties, you're sending in like a couple documents at a time because, you know, you're busy. People do that and that's fine. Then this could take a couple of weeks, you know, it just depends. But if you send us everything from the date we get everything, it's about a day, max 2 days that we'll have the approval done. And then what if I want to buy more than one property? Is the pre-approval good for multiple purchases? Yes. If, for example, you're like, Reed, I want to invest $250,000 into real estate. Like, what will that get me? Well, with 25% down and closing costs and having, if you have reserves in a separate account, that's going to get you about $900,000 of purchase price with 25% down. Well, Reed, I want to use the whole $250,000 towards down payment. Great. That's going to get you $1 million in purchasing power with 25% down. And we have to verify that based on income and all those other things, but that's the way that we approve you so that you can get a really good idea of how many you could buy at once. Again, we've done 9 at once pretty recently. You can only do 10 finance properties total with conventional financing, which I'm going to cover on some later slides. But again, yeah, we can shoot as many as 10 at once. A little bit about my team. This is my internal team that just works on my loans. I have a couple production managers that are amazing. They have underwriter designations as well. They've been in the business for over 20 years. They're my Rubik's Cube guys. You know, they put together the file for underwriting, make sure it's structured properly. They're my insurance on the transaction so that I can stay on the phone and doing consultations constantly. And I've also got some great staff that who you will talk with will be Jessica, and you'll be talking with Jana at some point, and then Mike. So Mike, Jessica, and Jana, those are the 3 people that you'd be speaking with personally off of this particular webinar that we're doing tonight. So you would be assigned to me, and you would then talk with Mike at some point, Jessica, and Jana. A little bit about the do's and don'ts. Just after you get approved, don't go and apply for any new credit. Don't go out and use your credit cards and overcharge on them and max them out. It will damage your credit scores. And if you're out shopping for longer than, let's say, 90 days, and then the credit report expires, and we have to update the credit, and now the scores aren't good, and we're pinched for time, you might get stuck with those scores. So after you get approved, basically try not to update or change any of your finances. Leave your money in the accounts that they're in. You know, don't go out and use your credit cards too much. And if you need to buy something, just let your loan officer know. Say, hey, I'm going to go buy a new car right now. The payments are going to be about $700. Is this going to affect me? Can I qualify still? Yes, you can still qualify. Okay. So just always be communicating. Some other things to do, like to stay at the current job. If you're going to go from a W-2 job to a new W-2 job, that's totally okay. We'll just get an employment contract, and we'll have to get a pay stub from the new job before you can close. If you're going to go from being a W-2 employee to a 1099 employee or self-employed, like, hey, I'm going to go start my new company now. Well, we're going to have to wait till you have 2 years of tax returns being self-employed before you can qualify. So W-2 to W-2, no problem. Self-employed, a W-2 job, we can take the W-2 income right away. But W-2 employee to self-employed or 1099, you'll have to wait for 2 years. And always stay current on all of your accounts. If you're late, even one 30-day late, it could really damage your credit. Over 100 points, it'll affect your loan pricing, and it'll take a long time for the credit to get better again. So how do we qualify you? I always love to go over this. Why do I believe so much in the real estate market as opposed to maybe 06, 07, 08? It was a very speculative market back then, but values were still going up. It was speculative. Anybody could get a loan. That's why values kept going up. Just you could state your income and you could still qualify. So speculative, but the values were still going up. Right now, the values have increased because of an extremely strong jobs market. Okay, extremely strong, and very, very tight lending guidelines we've had in place since 2010. So we qualify you on a debt to income ratio. Everybody that's been getting the majority of loans that have been done since 2010, you have to verify and qualify off your debt to income ratio, or you have to put a lot of money down, like 35% down minimum. Okay, so example of debt to income ratio: if you make $10,000 a month, let's say you had a W-2 income, your salary was $120,000 a year. You make $10,000 a month. Let's say that you currently rent, but you're going to go buy a new home. the payment for that home with principal and interest, property taxes, and homeowners insurance. The total monthly payment is $4,000 a month. And let's say on your credit, you have like no credit card debt, you have an auto loan for $500, that's it. You had a credit card that was posting a minimum balance, you had to pay $35 a month, but you paid that off. You have nothing reporting there. You have a $500 auto loan and you have a $4,000 a month mortgage for the property that we're going to apply for. So $4,500 of monthly debts we have to hit you for, divided into $10,000 a month of income. You would have a 45% debt to income ratio. So loans or items that are included in debt to income are minimum payments on credit cards, auto loans, mortgages, and then including any fixed expenses attached. So property taxes, homeowners insurance, any HOA, if you have mortgage insurance, any student loans, there's a calculation for that if you have it on deferral, but we have to take into account student loans. And then any other loan that's on credit, so installment loans or any other minimum payments on loans that are on your personal credit report. So we add those monthly amounts up and we divide it into your monthly income, and it gives us the debt to income ratio. Items that are not included, auto or health insurance, cell phone and utilities. So that's a good one to know, right? Utilities are not included. Loans to family and friends that are not recorded. If it's a recorded loan and that's on a title somewhere and then the underwriter finds that, you're going to want to say that you're making this payment every month. Business loans. One other item that is included in your debt is any spousal support or child support. And these are the max debt to income ratios you can go to for qualifying for a primary residence or an investment property. So the max debt to income ratio is 49.99%. So half of your money can be going out of your pocket every month. Now, it's very credit score driven. So like I spoke about earlier, credit's super important. If we verify the pricing on your loan and the eligibility of qualifying off the middle credit score. So when you go to buy a car, they run like one score usually. When you go to apply for a home loan, they're going to run Experian, TransUnion, and Equifax. And then we go off of the middle score between the three. And you really just want to be above 700 even for rate pricing, especially on an investment property. On a primary residence, there's great options all the way down to like a 640 mid-score. And I'm going to cover those in a minute. So moving into loan programs, you guys, we're first going to talk about the best loan program from a pricing standpoint. This loan program is going to have the best interest rates available. This loan program also offers as little as 3% down. FHA, which is a government loan program that's better when your credit scores are not as good, that program requires 3.5% down. So this program actually also offers the lowest down payment. So lowest down payment requirements for buying a primary residence or an investment property with the lowest interest rates. Conventional loan programs. When you hear the word Fannie Mae or Freddie Mac, those governments back in the 2008 crisis, they owned essentially more loans than anybody else out there. And in 2010, when everything had collapsed and there were all these bad loans that nobody was making payments on that were owned by Fannie Mae, the government came in and said, well, we're going to bail you guys out, but we're going to take over control of the companies. And all earnings you get for indefinitely till we tell you are going to go into our piggy bank now. And then they rewrote guidelines and made full documentation where you got to verify with income, assets, credit. They made it really, really stringent to qualify, right? So Fannie Mae, Freddie Mac are the same loans as conventional loans. So hardest to qualify for essentially because you have to verify income, assets, and credit. But if you have great credit or even good credit, you're going to get the best rates with the lowest down payment requirements. Now, nationally, that loan limit is capped at $417,000 from the early 2000s till 2015. Then once wages started to improve and the employment market started to get better, Fannie Mae and Freddie Mac started to raise their conforming loan limits. And they've raised them every year since 2015. And up until last year, it was only $548,000. And now this year they've raised it over 20%. again, we have seen real increases in wages. We have seen dramatic price improvements in everything out there. And it makes sense that Fannie Mae and Freddie Mac have raised their loan limit to 647,200. When they do that, we don't generally see home values go down 20% the following year. It's quite the opposite, even if rates are higher. And that's another reason why you're seeing so much resilience right now in the housing market. Tons of buyer demand. Fannie Mae and Freddie Mac allowing their loan limits to go up to 647,000 nationally. That's really, really helped, because now somebody that wants to put 3% down that has great credit can buy a house that maybe was, not affordable last year because his loan limit was capped at 548, but now he can go to 647. Awesome. I have enough money to do this. My income qualifies. Didn't have enough money last year, but now I do. Okay. If you guys
Reed, you there?
Can you guys hear me?
Yep, we can hear you.
All right, there we go. For some reason I lost it, but I'm getting some feedback.
Okay.
Give me one sec, guys. I'm trying to fix this. About now. Okay, I'm still getting some feedback, but I'm going to just continue. So this is going to be the best interest rates for higher credit tier borrowers. Again, best loan programs available for investment property. And you're going to have low mortgage insurance costs with less than 20% down as well. This is going to allow loan amounts all the way to $1.867 million. So in Orange County, you can go now as high as a 4-unit property. You can go to nearly a $2 million loan amount. You could do that with 20% down on a primary residence. You could do that with 25% down on an investment property. So just incredible. Hold on one sec. I'm getting a lot of feedback, guys. Hold on one sec.
If that works. Okay, there we go. Now I'm not getting any feedback. Thanks for holding for me, guys.
Loud and clear over here, Reed.
Okay, there we go. Okay, now here are the loan limits for conventional. So this is them in 2021, 548, 822 in the high cost markets. What is the high cost market? Los Angeles, Orange County, the Bay Area. So any areas that are extremely high cost, Fannie Mae would have lent to 822,000 with as little as 5% down. The high cost areas on primary residence, they'll allow you to do 5% down. On a low cost area or the standard conforming areas, they'll allow you to do 3% down. This is what they raised them to in 2022. Again, about 20% increase across the board. So now in Orange County, for example, you can go and do 5% down and go all the way to a $970,800 loan amount. You can do a 2-unit and go to a 1.243 loan amount, and again, all the way to 1.867 on a 4-unit property. Here's the history of Fannie Mae. So I just wanted to kind of show this. You guys can see, I mean, again, we were at 417,000 all the way from 2006 until 2015. 2016, they started to raise it, and it's gone all the way up now to 647,000. I believe that they'll probably raise it again next year a little bit, and that is something we're all waiting to see. Now, the all-in-one loan, I want to cover that a little bit. This is the only home equity line that I know of that offers a 30-year draw. So you can access your equity for the entire time that you have the loan. Most home equity lines are capped at 10 years. So I love the fact that you can draw on it for the whole 30. The other thing is, this is a first lien home equity line of credit. It's not a second lien, and it's tied to your checking account. So you actually create a checking account, and the balance in that checking account goes towards your loan balance on a daily periodic rate. So essentially how that works is, if you had $100,000 in your checking account that's tied to your all-in-one, and you had $1 million loan for the all-in-one, every day of the month that $100,000 is in your checking account, you are only paying interest on $900,000 of loan. Then if you took the $100,000 out of the checking account, now you're paying interest that day on $1 million of loan. So for people that have a lot of accounts receivables, or that are single person employees, or only have a few employees but have a lot of accounts receivable coming in, or even have a lot of rental properties, and you can use that as your property account, you can really drive down the interest that you're paying. You can act as your own bank, and the all-in-one is phenomenal. It's not for everybody, but for certain clients, this product is just insane. And now that you see interest rates haven't gone up as much as they have, the all-in-one rate, it doesn't seem as high anymore. Before, this rate was at 3.75 when 30-year rates were at 2.5, and frankly, I just didn't look at it too much. And now that the rates have gone up so much, I started digging into it. I started to write a couple of these for clients, and I thought about getting one for myself even, at least on my primary residence. So very, very cool loan. If you want to know more about it, this is CMG's proprietary product, like I said earlier. So the owner of my company created this product. So I can dig into that more with you guys on a follow-up call if you're interested. VA loans, you serve our country, you deserve to have the best type of loan out there. VA loans allow you to go with 100% financing with no mortgage insurance. Whenever you put less than 20% down, a lender needs to provide insurance, okay, or they cannot write that loan. So how they get that insurance is they go to a mortgage insurance company. And there's like as many mortgage insurance companies as there are lenders. So we shop it out to every MI company out there, and whoever has the best rate, we then use that company. So when you do less than 20% down on a conventional loan, you have mortgage insurance. VA is the only type of loan that you can go with zero down payment and have no mortgage insurance. It's for primary residences only. You can go to a 57% debt-to-income ratio, so much higher than on any other loan program. And then the other thing is there's no cap for VA financing. What that means is you can literally do a $5 million loan amount with zero down. There are colonels and captains down in Coronado Island where one of my colleagues, Corey Kavanewski, who's another producer for CMG, he's a very large producer. He's actually the top funder in the whole company. He's out of Coronado Island, and he constantly does $2 and $3 million VA loans with zero down. I did my first $2 million VA loan with zero down. I think it was in 2021. But so again, it's pretty cool. You can go zero down and you have no loan cap. So keep that in mind. FHA financing. So if your credit maybe took a hit because of, some collections a couple years ago, or you had a foreclosure or a short sale, but 3 or 4 years has gone by and everything's gotten better again and you have money for down payment. If you're a first-time buyer and you just had a lot of debt, and your credit scores are just not that great, but you have the money for down payment and you have some good savings and you would rather be a homeowner than, renting, FHA is amazing. 3.5% down is all that it requires. You can get FHA financing with as little as 3.5% down on a 2-unit property also. I have buyers that have perfect credit, but they just love the fact they can do 3.5% down on a duplex. If you do a conventional loan, you need to put 15% down on a duplex. So if you want to buy a property in, let's say, Los Angeles, for example, and you want to buy it for $1.3 million and put 3.5% down, as long as your loan amount because FHA has the same loan limit as Fannie Mae. As long as your loan amount's below $1,243,000 for a 2-unit, you could do 3.5% down. So just a pretty cool product. For 3 and 4 unit, it doesn't work, and I could explain that on another call. But basically, just you're not able to find properties that have enough rent to cover the total monthly payment on 3 and 4 unit. And there is a guideline that says that you have to have enough rents coming in off of the units to cover the total payment in order to go with that little down on a 3 and 4 unit property. And it's just with where prices are at, where rents are at, where they've been since around 2013 or so, or 14. You just haven't been able to find properties that debt service in that way to go with that little down payment on FHA. But that does not, that guideline does not apply on 2-unit properties. So that's what's pretty cool about it. So again, 1 or 2 unit, you can go pretty high on a 3.5% down payment with FHA. Jumbo financing. So as rates have gone up, you see a lot more ARM financing out there, so a lot more adjustable rate mortgages. Those loans are generally fixed for 5 years, 7 years, or 10 years, and then the interest rate can adjust after that. I can educate you guys on how those loans work on a follow-up call. I think that if interest rates had continued to go up and if the 30-year fixed rates were in like the mid-6s or even the high 5s on like a jumbo loan, then you really start looking at maybe doing a 5 or a 7-year, because my opinion is in a couple years you'll probably have lower rates again and you'll be able to refinance. I'm going to cover that on some further slides when I do my market update. But the point is, you can make sense of a 5 or a 7-year loan if you believe that rates will be lower again in the future, for one, but really especially if you're not planning on staying in that home for too long. I would still, as long as 30-year rates are not too high, as long as they're palatable even, I would always do a 30-year fixed over an ARM product if it's a home that I'm for sure planning on staying in. And I'm a bit more conservative, so for me, I'll just do a 30-year anyways, and then at some point in the future when rates are lower, I'll just refinance the property and do another 30-year fix with a much lower rate. So for me, I'm more conservative. I prefer the 30-year money, especially with where it's at right now versus ARMs. But again, on a 5-year, 7-year, or 10-year, if you're not looking to stay there for too long, especially, that product can be great. There's also options available for interest only. I think you should be paying principal every month if you can, because you want to pay off what you owe on the property. That's how I'm very conservative in that way. That's how I've always set myself up. But some properties make sense for interest only. If you're only going to live there for 5 years and you want to keep more of your money invested, I have a lot of clients that are buying $4 million homes, getting a $2 million IO loan, because they want to keep as much of their money as possible out in their investments. And they're only going to live in the house 5 years before they buy another $5 million home anyway, so they don't really care. And they're not trying to pay off the home that fast. They're not worried about that anymore. So some scenarios, I really do think ARMs can make a lot of sense. But buy and hold, I'm more a 30-year fixed guy, especially with where rates are at now. And you can always just refinance if rates go back down. Oh, this is in here. Who's this guy? That's me. Actually, I mentioned American Direct Mortgage, so you can see that in the banner in the back. So that's when I started working for the first lending company, and I think I was maybe 20 years old right there. So love what I do. I'm so intense right there. It's pretty funny. Okay, down payment requirements for buying investment properties. So believe it or not, you can go as little as 15% down, and you could do it with a 660 FICO score. Your pricing will be atrocious, but you could get technically qualified buying that way. In this market, we really advocate putting at least 30% down. You know, you're still going to get a great return on investment. You don't have to put 20% down to get a good ROI, or 25%. You can put 30% down, get the property to cash flow with where current rates are at, and then maybe do a cash out refinance in 5 years if the values have gone up more, and if the rates happen to be lower, maybe you could cash out refi with 1% lower in rate and pull some money out. But until then, you're buying it right. You're making sure that it debt services, right? You're buying an A-class property. You know, you're buying property that are going to be less headaches, that'll have better tenant quality. Putting 30% down right now is really the way to go. 25 is okay also if you can handle maybe a little bit of negative cash flow. Some properties may even cash flow with 25% down. If rates come down a little bit, that'll only look better. But again, you can go as little as 15% down on an investment property. We advocate putting 25 to 30% down. For a 2 to 4 unit property, so that was 1 unit. 2 to 4 unit properties, conventional will only allow you to do up to 4 units. Outside of that will be 5 units plus would be commercial. But on a 2 to 4 unit, you have to put 25% down. That's the minimum. And if you put 30% down, the pricing is much better. And so again, for that reason also, we really advocate 30% down. Now, when you have 7 to 10 finance properties, so over time, as you build your portfolio, and maybe you have, 4 finance properties now, including your primary residence, and you're going to go buy a 5th property. For that property, you only have to put a minimum of 5% down more, so you got to put 20% down. 2 to 4 unit has the same down payment requirement. And the only difference, so to get the 10 finance properties, you have to have a 720 mid-credit score. So it's almost the same exact guidelines. And your credit will do better and better over the years with mortgage debt. If you're paying your credit cards off and you're not financing things you shouldn't be financing if you don't need to, and you kind of know what I mean by that, like don't go finance a blender, or don't go finance something like that, because that stuff really does quantify to hurt your scores. You don't need to do that. But if you just have mortgages and over 5, 6, 7, 8, 9, 10 years, you've got 4 or 5 properties, your credit will just get better and better because mortgage debt is considered good debt. And as those payments are made every month, your credit just gets stronger and stronger. But so for doing 10 finance properties, just keep your credit good. And you can go now with as little as 20% down all the way to the 10th financed. A couple other things that you need to know. You've got to have 6 months reserves for each property. Retirement accounts are considered reserves as well. What are reserves? How much money are you going to have in your different accounts after closing? After you close on that purchase, how much money does he have or does she have? And it's so 6 months PITI, 6 months of principal, interest, tax, and insurance. And if there's any HOA on the property, that'd be included too. So 6 months of those payments in reserve for every one of your properties. That's the reserve requirement for getting to 10 finance properties. The max debt to income ratio, when you go over 7 properties, drops to 45%. So you have to make a little more money. Remember, you can go to 50% before that, 45% for 7 to 10 finance properties. So you need to start making a little more money also to get to that 7 to 10. And it's 1 to 4 units only. A couple cool things to know is you can have multiple loans. It's just you can only have 10 finance properties. So you could have a first and a second loan on every one of those if you really wanted to. It's about the number of finance properties. So again, you can have a first and second on any of those properties, but you can only have 10 individual properties that have loans on them. Anything above that, you will no longer qualify for conventional financing. And if you already had 10 properties, but they're all rental properties, you could go buy a primary residence always using a conventional loan. So primary residence is outside of that box. So really you could have 11 finance properties if you waited to buy your primary till the end, or if you sold your primary after you had 10 and then bought another one. Okay, actually you could sell your primary if you had 10 total, buy a 10th investment property, and then go buy a primary residence and have an 11th. And it's only available for 15-year and 30-year fixed. I get this question all the time right now. Well, what about ARM loans? Aren't ARMs better on investment now because rates are down? Absolutely not. ARMs are considered, adjustable rate mortgages are considered risky mortgage products. Investment properties are considered a risky bond asset because if someone was to lose their job and they own 2 investment properties and 1 primary residence, they're likely to let go of an investment property first before letting go of their primary home, where their children, live close to the school. So for that reason, there's more emotional connection for a buyer or borrower to the primary residence versus an investment property. And so for that reason, they consider investment property loans to be more risky. So when you add a risky mortgage product like an ARM, adjustable rate mortgage, with an investment property, those classifications of risk actually make pricing much worse. So your 30-year fixed traditional financing is better priced. So 30-year fixed are still a much better option than doing an ARM for an investment property. For a primary residence, again, I talked about it earlier, there's different scenarios and an ARM can make a lot of sense, especially if rates get better in a few years and you could refi. For investment property, I still say do a 30-year fixed right now, like I just talked about, and you could still look to refinance when rates come down in the future. A few more frequently asked questions is, so I get this a lot, Reed, I'm already at a 48% debt ratio. How do I go buy another property right now? Well, we know you're buying a rental property, and we can take 75% of the projected monthly rental income on that property and add it onto your income towards qualifying. So if it's going to rent for $1,000 a month, we can take $750 of that and add that onto your income, right? That's just an example. So a lot of these properties pay for themselves. If you're buying a 4-unit property, there's situations where the gross rents, 75% of the gross rents are higher than the mortgage payment's going to be. And we actually are adding income onto this guy or onto this borrower by buying this 4-unit property. So not only does the property pay for itself, but we're actually adding income on. So that's a pretty cool rule. So you should be able to qualify if your ratios are under 50 if you're buying an investment property. And how do we factor that in? There's a separate document included with your appraisal that the appraiser will pick 4 or 5 other rental properties in that area that you're buying in, and they'll give the average rents on all they'll give the rents on all those and then give you an average rent, and then we take 75% of that amount. If it's already pre-leased, then we'll take 75% of the lease. If the lease is super low because it's been managed by a terrible property manager that never rent increases, there's a lot of them out there that do that. Marcia Reddick is not one of them. Every single year I get a notice, hey, we want to raise the rents, and that's part of this business, you know. So, but if you have someone that's paying way under market rent for a home that you're buying, it's currently rented, then we need to have more rental income because your debt ratios are tight. We'll be able to get that rental survey included in the appraisal, and we can go off 75% of market rents, even if it's leased way under. So know that. And then Marcia Reddick will talk to you about how it works with getting the rents up after that point, after you close on the property. Okay, so when you can't qualify for conventional, Marcia Reddick has put together amazing, amazing options. They're only for investment properties. You can access this data anytime by going to marciareddick.com and click on the Borrow tab. Everything is right there. Click on their loan programs. You can see what they offer. They've got renovation loans, bridge loans. They've got long-term financing. Their 30-year fixed rate is phenomenal. And where it would work best, especially, is if you're buying out of a self-directed retirement account. Maybe you've got an IRA and you want to sell some stock and loosen up some cash and go buy 2 rental properties out of your IRA. You know, maybe you want to self-direct that IRA and, you know, it doesn't own any stock right now, but you want to put that money into real estate. You can buy with a self-directed retirement account loan offered through Marcia Reddick. When you use a conventional loan like I'm talking about for 1 to 4 units, you have to qualify personally. You have to personally guarantee that loan. It's going to go on your credit. The type of loans that Marcia Reddick offers, they offer asset-based loans that are not going to go on your credit. So they require usually a little bit more money down than my loans. The rates are a little bit higher. The terms are a little bit different. But again, if you're buying out of a self-directed retirement account or if you just can't qualify for conventional financing, they have the best private money that I've seen of anybody out there, whether you're doing like long-term buy and hold or renovation loans or bridge loans. They've also got new construction loans, another thing that we're seeing a lot of right now. We're seeing builders don't want to finance the construction. We're starting to see some little changes in the market, so they're coming up with some great programs along with my company CMG that we're going to be able to put out there pretty soon here for construction loans. So you guys will see some more data on that soon. Okay, before I move into this, everybody take a few breaths real quick, stretch a little bit, because I'm going to go on into a market update. I want to talk to you guys about what's happening with interest rates. I mean, I see 7.5%, 8% out there. I'm seeing, you know, people talking about 9% rates for 30-year fixed conventional loans. I'm seeing all kinds of stuff. So I want to demystify some of that today. I want everyone to get off the call tonight feeling like they're a little more educated on why does the Fed actually raise interest rates? How is that actually affecting us? So I'm going to dig in here for a little bit, and I'm going to go into that data. So this is the average 30-year fixed mortgage rate since 1971. So 6.67% has really been the average. I have another slide here later that shows you this rate all the way to today, but I like this graph because it shows you the peak we had of 18.45, and then it shows you where the average has been at about 6.67. Now, rates hit 18.45% in the early 80s because of the Volcker Act, okay? We had basically at that time throughout the 70s, it was a completely oil-based economy. We still are, but back then it was extremely oil-based. The price of oil was going up. The cost of every last thing out there was going up right away with it. And what you had was you had everybody in the world at that time was trying to get as much output of oil as possible. Everybody was digging for oil. And you got to a point towards the later 70s, there was no more oil to dig. Then you had the Yom Kippur War, and you had OPEC shut off their oil to the rest of the world when you already had max output. So some of you may remember, I don't remember because I wasn't even alive then. I was born in 1985. But many of you guys will remember that there were, like my mom remembers, there was gas shortages. People were like holding on to gas, siphoning gas. So that's what happened. And as a result, inflation, producer prices, the cost to produce, the cost of goods, inflation, kind of like you're seeing today, went completely nuts and out of control, where Paul Volcker, the Fed chief at the time in the early 80s, had to raise the federal fund rate. That's the rate they keep talking about hiking, that is under 1% today. They had to raise that rate all the way above 20% to slow down inflation. Now, what's different about today? That was actually a fairly weak jobs market back then. That economy was actually not that strong. The economy today is extremely strong. The jobs market is extremely, extremely strong. It was just a totally different world. So no, we're not running into a we're not running into a Paul Volcker situation right now. But again, very interesting when you see that, and when you see what's behind that. We got super high oil prices right now. That's very, very scary. But I'm going to break down why we're in no way, shape, or form looking like that today because of how strong the jobs market is and technology, and just a totally different world. Why do rates matter? Every 1% increase in rate is a 12% increase in your monthly payment. That's why rates matter. Now, what have rates done this year? I'm going to teach you guys how to read this. This is the Fannie Mae 4.5% mortgage coupon. This is the most closely correlated and tied mortgage-backed security or mortgage bond tied to the loans I'm talking about tonight. That's $647,000 standard max conforming loan limit. That's a Fannie Mae loan, right? You're looking at a Fannie Mae mortgage-backed security screenshot. Every one of these little lines is a day of trading Monday through Friday. Green, in that day, investors were buying the bond, causing the bond to appreciate and driving down the yield. Rates actually go down. So the higher up this is on this chart, rates are better. When you see this thing going down, like recently, that doesn't mean rates are going down. That means rates are going up. This is selling off. It's causing the yield to go up. So when you see red line, that means investors that day, large hedge funds, big institutions, they're selling this debt. That causes the bond to depreciate, and it drives up the yield and makes rates worse. So again, this is the most closely tied mortgage bond to the loans that I'm talking about that most of the United States is financed on. Now, every one of these little bonds that's traded is not one loan. It's packages, it's bundles of $3 to $5 million or $10 million of this loan, and it's bought and it's sold and it's traded on the secondary market. So I'm going to talk about these highlighted points. This is your chart from the end of 2020, so from November 27th of 2020 all the way to May 26th of 2022. So what do we have around last May? You had interest rates at the best point of the entire year. You still had a very dovish Fed. That means that the Fed was patiently waiting for economic activity to get better before they raised their federal fund rate. Why couldn't they raise their rate faster last year? The economy was already doing a lot better again. How come they couldn't raise it in May? Because unemployment was at about 5.8% still. They could not risk raising interest rates until we were at the same unemployment rate as before COVID. I mean, they put so much effort into getting us through COVID, they're not going to let the jobs market slip by raising rates too fast. Now, as a result, you saw the second highlight here right around September of last year. That's when the Fed realized, my gosh, inflation is way, way too high. Not only are the consumer prices too high because you've got supply chain issues because we were shut down as an economy for 4 months, right, in 2020, and it took a long time for stuff to get working again and all this demand for products and not enough products being generated to fill the demand, and so supply chain issues caused prices to go up, right? But they also saw it in wages. What they started to see was, my God, the wage inflation is around 5% plus right now, year over year. And we're all the way in September. We were expecting wages to cool back down to around 3% year over year this time, but they're at over 5%. That's because we created way too many jobs because we've been at zero for way too long. So they started to go, my gosh, we got to get hawkish. We got to start scaring the heck out of the market so that interest rates start to go up even ahead of these rate hikes. So when you get to this third highlight is where we started the year for 2022. And it was really just a weekly sell-off of mortgage rates. They got worse and worse and worse. Then we started to hit about a 4.5% on a primary residence, 4.375. They started to let up, and then we had really a gut punch to the Fed, and that was the Russia-Ukraine war, which has just been terrible. Moment of silence for what's going on over there. So we've got that terrible atrocity that's happening over there, and for anyone that doesn't know, Ukraine is one of the largest wheat farmers in the world. Russia is one of the largest oil producers, right? So when they went into this war, it's basically caused oil prices. They hit $125 a barrel. Highest price of all time was in around 2005. I think it was about $145 a barrel. But this caused oil prices to go up. And for any of you that don't know, we are still in an oil-based economy. If the cost of oil is going up, the cost to produce is going up. Even your vitamins, everything that you're working with, most of it is taking oil to produce it. So if the cost of oil goes up, the cost to produce goes up. The cost to produce goes up, that has to get put onto the consumer, at least while the consumer will take it. And we've had enough demand that the consumer's been taking it. But for how long, right? And so that added another layer here on top of wages being out of control. And so that scared the Fed to get really gnarly with their rhetoric and really what they told the market. So, you see from there, interest rates got worse and worse and worse until we get to this last Fed hike. Now, a lot of good stuff happened from that Fed hike. I'm going to say first, what is the Fed's rhetoric? What has the Fed been telling the markets? I'm going to show you that on the next slide first, and then I'm going to go into my next points. So what is the Fed telling us about rates? They're expecting to raise rates 6 times this year with 2 more 50 basis point hikes needed. They're no longer going to be purchasing mortgage-backed securities through their lending facilities that were creating during the pandemic. So they were buying about $50 billion a month of this type of debt I'm talking about during the pandemic. That's how all those 2.5% rates are being originated by banks like me. We're selling those loans to Fannie Mae and Freddie Mac. So all of those loans were being bought by the government. Well, what they said is we're no longer going to buy anymore. We're taking a break. So we're still going to buy with what gets paid off every month. So when people retire their 30-year loans, they sell or they refinance, we'll still use that money to keep on buying mortgages. But we're not going to use any of the other money that was printed during the pandemic for this. We're not doing that anymore. We're done. Then they came out to say a step further. When they saw the Russia-Ukraine war happen, they got really serious about this. It was just talked about before that. But when that happened, they said, my God, we got to get really, really strong on this to be safe. They said, we're going to let $17 billion a month of these mortgages that we essentially bought during the pandemic. Now, as those get paid off, starting on June 1st of this year, we're going to let those bonds roll off our balance sheet. Meaning when someone pays off their loan, they sell, they refinance, instead of using that money to go buy another mortgage-backed security, which they've been doing that for years, it's called shadow quantitative easing. They've never stopped doing this. They've always done this since the crisis. They just stopped printing money and then putting it into it. They were just using what was paid off and then buying it again. But they said, we're no longer even going to do that. We're going to let $17 billion a month roll off of our balance sheet starting on June 1st. That scared the market a lot because that bond market I just showed you on that screenshot, over 50% of people buying that is the Fed. If they're not buying it anymore, someone else has to buy it. Supply and demand. Well, the rate on that's got to go up a lot. Otherwise, no one's going to buy it. Those rates are too low for private money to come out and start buying or institutions to start buying a lot of that debt. So that's what caused rates to go up even before these rate hikes, right? Because they just mentioned that. It's about supply and demand. And they said starting on June 1st, again, they're going to let that roll off. Inflation's just way too hot. We need proof inflation is cooling, and that they want to see that target for growth, for wage inflation growth year over year at around 2%, where it was at before the pandemic. So I want to break down what the Fed's doing here. The Fed has been using their rhetoric to artificially push rates up way ahead of the rate hikes. The federal fund rate before COVID was 1.75%. The federal fund rate today is 0.75 of 1%, lower than before COVID. Before COVID, interest rates on a 30-year loan were 3.625% for a primary home, with a 1.75 to 2% Fed fund rate. Today, interest rates are 5.25% for a primary residence loan, with a Fed fund rate below 1%. Why is that? The Fed's rhetoric, what they're talking about here, the bond roll-off. Now, back to my chart. Why on this highlight, the second to last highlight over here to the right, when rates are at the worst point, why did they start getting better again when the Fed raised rates recently 0.5%? Because during that meeting, they announced the $17 billion is going to start in June, but he snuck in a comment, and his comment was that, well, but at current interest rate levels, we don't believe we will need to fully allocate this amount. What that meant is there isn't $17 billion a month of these loans being paid off. Do you notice your friends and family that got a 2.5% or 3% 30-year moving right now unless they absolutely have to? Very few people are. Do you notice all the investors that have bought property over the last 5 to 10 years selling all their property? Maybe they're 1031ing into other property. For most of them, they're holding. There's not $17 billion a month of loans to retire, especially not ones that were bought during the pandemic. There isn't nearly that amount. This is rhetoric. It's proven rhetoric. It's been put out there to raise rates ahead of the rate hikes to slow stuff down. Let me break down what happens when you have rates at zero for too long. Okay? Again, rate before COVID for the Fed fund rate was 2%. Fed fund now, 0.75. 30-year fixed rates when wage inflation is normal at 2% year over year, rates are 3.625 on a 30-year fix. Current rates today, 3.25. Now, what was the unemployment rate before COVID? I'm going to break it all down right now. The unemployment rate before COVID was around 3.7%, and there was about 7.5 million unfilled skilled labor jobs. For any of you that don't know, you can look at the JOLTS report. It's the Job Opening and Labor Turnover Survey. You can Google that and get all the data you want on employment and on what jobs are available. And this is posted every single month. So there were 7.5 million unfilled skilled labor jobs, which is a lot. That's why we still had some pretty good wage inflation at about a 3.7% unemployment rate. So almost everybody has a job. Now fast forward. The Fed kept rates at zero for an entire year longer than needed. Why does the Fed want to raise rates? They really want to raise rates to slow down job creation. When rates are at zero for too long, when they're at zero period, companies, small companies, middle-sized companies, large companies, they take out loans to expand. When you're a company and you expand, what do? You need more employees. What about when you're also coming out of COVID and you had to staff jobs that maybe nobody ever even came back to, on top of the fact that they've been expanding, they've been growing. There's been so many jobs getting created for so long because interest rates have been at zero. So they raise interest rates to slow down job creation. You know, you're at Facebook, you need 20 more programmers for this project. Where are you going to get them? There's not enough programmers. Well, I'm going to go over to Google. I'm going to give them 20% more to come on board. That's what happens when you don't have enough people to fill jobs. You get a lot of wage inflation. But what's been happening recently? Facebook no longer hiring programmers. Companies throwing up bad earnings reports. What happens when you have bad earnings reports? It's a public company. It's got to get profitable again, right? How do you get profitable? Well, if the cost of your goods is so high right now because of high producer prices and, you know, retail is still strong, people are still buying stuff, but they're already starting to not buy as much of your product because it's expensive. How are you going to get there? You got to cut employees. Now there's less people in the workforce. Now that 11.3 million unfilled skilled labor jobs today. We're at 11.3 million unfilled jobs with the same unemployment rate as before COVID. There's too many available jobs. That's what's been causing all this wage inflation. And now with the Fed raising rates like they've done, with the Fed sucking 20% out of the S&P 500 and out of the 500 largest stocks that are on our market, that has already helped business investment and new jobs go down. I believe we will start to see this data very, very soon, slower wage inflation. You will then get the Fed's rhetoric to calm down a little bit. A lot of this rhetoric right here, like they'll start to pull back on this rhetoric slowly. The $17 billion that's supposed to go to $35 billion a month, 3 months after June, after 3 months we're going to go to $37 billion or whatever. No, you're not. No, you're not. You're going to take that off at one of the next Fed meetings after we've shown proof. Remember, they need proof that inflation's slowing. They need proof. Now, the last point I want to make is last May, or let's say March, over this March, totally different numbers. Last March, we were crawling out of COVID still. My children only just recently, 2 months ago, no longer have to wear masks to school. You know, my 6-year-old. When you think of last March over this March, it makes sense we have a lot more economic activity. And these numbers are just really extremely, extremely high. It makes sense even April over April. Last May over this May, I think you had a lot more economic activity last May. I think more than in April. I'm hoping that we start to see some slower wage inflation. We see some economic activity slowing. Now, consumer prices on goods not coming down right now no matter what, guys, because oil prices are so elevated. We need to get oil down to $80, $70, $60 a barrel again, okay, so that the cost to produce goes down. Also, with Russia and Ukraine war going on, which is, I hate to say it, it's probably not going to end for a long time. That's going to continue to keep oil prices elevated until maybe OPEC starts really letting off the gas and letting oil flood the market. I mean, there's different things they could probably do here, but it's still going to take a while. The cost to produce and the cost of your products will probably stay high for a while, but that's not the reason why the Fed has had this harsh rhetoric and pushed rates up into the low fives in literally 3 months from being 3% to start the year. They've done it mainly because they know if they slow down jobs creation, they slow down wages, they slow down that side of the growth, that everything else will start to come down with it a little bit. Now, there's some risk to this all, but again, when you look at the buyer demand for real estate, when you look at the amount of available homes that there are, when you look at the average amount of equity that homeowners have in their home, I mean, it's very, very hard to find a really bad case right now for real estate unless interest rates go to 8.5% and they stay there for 2 years. Okay. Now, I want to tell you this also. The Mortgage Bankers Association that tracks this data very, very closely, their opinion is that we will have a 4.8% average 30-year rate for the last 2 quarters of this year. Their prediction is that we will have a 4.8% average the first 2 quarters of next year, and that it will drop to around 4.6% the last 2 quarters of next year. They also believe that in 2024 that we're going to see 4.3% for the first quarter. Now, I think that that's a pretty good prediction. I think if we start to see slowing wage inflation now, May over May, which we get that data next week, we'll get some data on the 31st, and then we'll get some data going into early June, and we'll be able to see, hey, like, is it really slowing down? Are wages slowing down? If they haven't slowed down much, I think you'll get that data in June. At some point, you're going to get that data. And I think that, we're in a hot purchase market that can definitely handle a 5% average rate for a long, long time. I see it. I'm in the market daily. The buyer demand is insane. When rates are, 3/8 higher than they are right now, when they hit their highest point back on that chart like I showed you back around when we had that rate hike, the buyer demand was still extremely strong. Now, if rates stay in the high fives or they even go higher than that and they stay there for a while, 100% it will slow down real estate. I still don't know that you'll get a mass exodus of sellers. I still see jobs being extremely, extremely strong, technology being so strong. I don't see this big recession in real estate regardless, although I do see that you will see some pockets come down. You're already seeing that in certain areas, the luxury markets in California and whatnot. But in your bread and butter, A-class, single-family home, 4-bedroom, 3-bath in San Antonio with an attached garage, I mean, who cares? You're not buying every property in 1 year. It's not about timing the market. You just buy one here, and you buy another one in a few years, and you buy two maybe that next time you do it. And before you know it, it's speckled out. And then before you know it, rates come down again, and then you can refinance those ones that have higher interest rates. It's just how it works. So to my last chart here, I got to go over because this one is amazing. This is your 30-year. I've never been able to find one until now that goes to current day. This one goes all the way to current day. You see back here in the early 70s, rates were around 7%. You then see this little one that I first highlighted, that's just over 5%. When was that? I want to talk quickly about this. This is the proof in the pudding here. In 2017, we had tax reform. It caused an enormous amount of wage inflation in 2018. Now, all through 2018, the Fed hiked interest rates to slow down inflation. There was one point that Jerome Powell said, I do not know where the neutral rate is on the federal fund rate. That means, like, I don't know how much I'm going to have to raise rates to slow this down. We have no idea where neutral is. And remember, we were coming out of a very, like, predictable time. The market was very predictable from 2013, 2014 till around 2017 until Trump was elected. It was very predictable, actually, very predictable. Then it became very, very unpredictable. Now, all through 2018, though, we watched what happened. Rates went up. It cooled down the economy. Rates went a little over 5%. You could Google Wells Fargo mortgage rates today, and you would see about a 5.25% interest rate for a 30-year fixed. Okay? Now, then what happened? All through 2019, they actually ended up cutting rates the first quarter of 2019. They saw economic activity slow. They saw wage inflation cool a bit. And then they let the rest of the year go. They didn't do anything with rates. And by the end of 2019, the federal fund rate, that's their overnight borrowing rate, all right? That's what all these banks, institutions were getting this money at 0 to 0.25% forever. That overnight rate was just under 2% right before COVID in the beginning of 2020. And 30-year mortgage rates had calmed back down, like I said earlier, to a 3.625%. When you look at this chart, you see before COVID, 2018, when we hit that high, you see how they slowly over time drifted back down. Then we had COVID. They came rushing down, obviously, spiked a little bit in early 2021 when we were coming out of March and they were starting to be, administer a lot of vaccines. And everyone's like, oh, my God, is COVID going to go away like right away? Like, oh my gosh, rates got to spike. That's when we had that little rate spike last year. Then, oh, no, unemployment's still at 5.8% and COVID's still a huge deal. Like we need to just let rates come back down again. And they came back down again, as you see right there. And then that was pretty short-lived. And then you see what's happened all of this year, right? Just really a rush to slow things down. But my point is this year is looking a lot to me like 2018. You're getting a lot of the same data coming out of the feds, a lot of their same rhetoric, a lot of how they do things, how they talk, how they posture. Like, it's very, very obvious, in my opinion, that we may start to get some seriously lower data and wages, and that you may see rates come back down again a little bit, or at least stabilize. What's the flip side? We'll still see higher data for the next couple months, and this trend line will go up higher, and rates will have to go up another 0.5%. It's possible. It's definitely possible with oil prices too so elevated and with just where the state of the economy is right now. I mean, again, you're still going to see higher consumer prices and producer prices regardless. I just can't imagine, though, that if we start to see proof that wages are coming down, that you don't see a Fed that starts to become more dovish. And then again, then you'll see lower interest rates. They won't be right away. They won't be as low as what you probably want, but they will help the buyer environment. People will keep buying through this. And then I think that you'll see at some point in the next couple years, you'll see like what we saw in 2019 into 2020. You'll see an opportunity where you're like, my God, 3875 is like advertised again, like without a bunch of points and BS. You might see that. And then you go, great, what's an investment rate? 4.625? I have a 5.5. Oh, I can get that for $3,000? Awesome, let's refi, Or maybe you'll wait 5 years and we'll have a 3.5 rate again. But definitely when you look at these similarities, they're pretty hard not to look at. Okay, that's my update for you guys. I have a weekly update. It goes out every Saturday. If you guys want to be added on it, we always add everyone that attends these. So you'll start to get this email. You can opt out if you don't want to be in it. But it's great information. It goes out every Saturday. just kind of a dummied down version of what happened in the week before. Why CMG, all 50 states, can lend anywhere, purchase lender. We're the 10th largest mortgage bank in the nation. So we're a very safe institution. We're very well capitalized, and then obviously you get the big bank rates, but you get the smaller team service, which is great. And then obviously we specialize in investment property financing. Again, I have private products that are securitized by CMG that are Fannie Mae sellable. It's a Fannie Mae loan, but if your credit score is above a 700, you fit into this box, and we have special pricing that we provide for the investor client, for the Marshall Reddick client, frankly, because you're using property management, you're educated, and I've been able to get these products put together over the last 6 months so that I can have extremely aggressive pricing in the event that rates stay this way for a while. So keep that in mind. Some of our reviews online, just Google my name. You can get a nice little list of our reviews and see what other people are saying about us. And this is me and my family. I live in San Clemente, California, too, so I'm down here in Orange County. I also go to the Marshall Reddick office and work out of there a few times a week. So I'm very connected, and you guys call me anytime that you need me, and I will be here. Vince, back to you.
Awesome, Reed. Thank you so much for the thorough presentation. That was super, super helpful, and really excited you were able to jump on. So guys, just really quick while we wrap up here, just quickly, we have our Marshall Reddick rating ebook. This kind of gives an indication, and it'll help explain the property classes. Each property that you're going to see on our website has a property class associated with it. This book does a really good job in breaking down how we arrived at that and kind of the reasoning behind it. So this is free on our website. The website is below, but any property you click on the right side, you'll see this the ability to access this ebook. I'm going to be doing calls after this presentation, so most likely tomorrow and maybe beginning of next week, just to kind of connect and see if there's anything we can do to help. It's basically call it a consultation call, call it a follow-up call. These calls could be as short or as long as you want. Ideally, I'd like to try to go over the who, what, when, where, and why. If there's any interest in properties or kind of why you decided to join the call tonight, and if there's any specific questions just for directly to Reed, I'm more than happy to help facilitate that and connect you guys accordingly. But nonetheless, you should be expecting a call from myself to go over those things. Here is my contact information if anybody needs anything or you wanted to reach out to me direct. I see there were some questions that came through. Just based on time, what we'll do is we can follow up with you guys individually to help answer your questions, and a good time to go through that is on the follow-up calls. So here's my contact information below. Again, we want to thank you guys for joining us this evening. So helpful, and I want to thank Reed for taking the time tonight to go over everything. So thanks so much, Reed, and thanks you folks for attending.